All right, ready to dive in. Today we're tackling how to actually get started with investing. Remember all that groundwork we laid comparing stocks and crypto?
Yeah, feels like we've been window shopping, right?
Exactly. But now it's time to open those doors and figure out how to actually get in the game.
It's like we're ready to hit the stores, wallets in hand, ready to buy. And judging by the pile of sources you've gathered, you're interested in both the stock market and that wild world of crypto, huh?
You got it. We've got these in-depth guides, articles even. Wait a sec, is that a children's book about Bitcoin, I see?
Oh, wow, that's pretty cool.
Gotta love it. Clearly, you're looking for a solid understanding of both brokerage accounts and crypto exchanges. So no matter what your level of experience, let's just break it all down.
Sounds good to me.
Perfect.
Yeah.
Let's start with those gateways to the stock market, right?
Right.
Brokerage accounts. What are those all about?
Well, think of them like your own personal toolkit for the stock market. They're basically these platforms that connect you to the exchanges where all the buying and selling of stocks happens.
Okay, that makes sense. But there are just so many options out there. How do we even begin to pick the right brokerage account? I know our sources mention some key factors, but I'm curious, what really matters most for someone who's just getting started?
That's a good question. For a beginner, I'd say the top three things you got to consider are fees, how easy the platform is to use, and the educational resources they offer. Let's start with fees. You ideally want a brokerage that offers commission-free trading.
Commission-free.
Right. That means you can buy and sell stocks without paying a fee for each transaction,
Hmm.
which, let me tell you, is a huge plus when you're starting with, maybe a smaller amount to invest.
That makes total sense. You don't want those pesky fees eating away at your potential profits, especially early on.
Exactly. Now, ease of use is also crucial, especially when you're new to the whole investing thing. You don't want to get stuck with some clunky, complicated platform. Look for brokerages that have intuitive websites or even mobile apps. Things that make it really easy to manage your investments.
Some even have those demo accounts, right?
Yeah, some do. Those are fantastic for practicing before you actually use your hard-earned money. It's like taking a car for a test drive before you commit.
Love that analogy. Speaking of learning as you go, what about those educational resources? Seems right up your alley.
Absolutely. A lot of brokerages offer tons of educational stuff like articles, videos, you name it. Some even have webinars and personalized advice or even robo-advisors.
Oh, but what now?
Robo-advisors. They use algorithms to kind of help you build a portfolio based on your goals and how much risk you're willing to take.
Wow, it's like having a little investing coach right there in your pocket. So once you've found a brokerage that checks all those boxes, how do you actually open an account? Is it a big hassle?
Not at all. It's surprisingly simple, actually. It's basically like signing up for any online service. They'll ask you for some basic info like your social security number, bank account details, stuff like that. You agree to the terms and conditions, and bam, you're off and good to go. That's good to hear. Now, before we get into the exciting part of actually buying stocks, can you walk us through those different types of orders? I remember reading about market orders and limit orders, but I gotta admit, I'm a little fuzzy on the details.
Sure. So think of it this way. A market order is like saying, hey, buy this stock right now at whatever price it's going for. It's definitely the fastest and simplest way to buy or sell, but sometimes a limit order might make more sense.
Okay, what's a limit order then?
With a limit order, you set a specific price you're willing to pay for that stock. Like say the stock's trading at 50 bucks a share, but you only want to buy it if it drops to, say, 45. So you set your limit order at 45, and if it hits that price or lower, your order automatically goes through.
So it's kind of like setting up a safety net.
Exactly. You're not accidentally overpaying. Limit orders give you a bit more control, especially when things get a little crazy in the market. That's a great strategy. I can see that coming in handy. All right, let's shift gears a bit and talk about cryptocurrency. Tell me, how do crypto exchanges differ from those traditional brokerages we were just talking about? I feel like they have, a bit more of a Wild West vibe, don't they?
Yeah, they definitely have a different feel to them, but just like with traditional investing, finding the right platform is really key. Think of crypto exchanges like online marketplaces. It's where you can buy, sell, and trade all those different cryptocurrencies.
Okay, that makes sense. So similar concept, different assets, but with so many exchanges out there, how do we even narrow down the options? What are the most important things to consider when choosing a crypto exchange?
Well, a lot of the same principles still apply. You want to look at fees, ease of use, all that. But when it comes to crypto, security jumps to the top of the list.
Makes sense. It's all digital after all.
Right. You're dealing with digital assets, so choosing an exchange with really tight security measures is absolutely paramount. You don't want to mess around when it comes to protecting your crypto.
Absolutely. So what are some of those security features we should be looking for? Give us the rundown.
Okay, so definitely look for things like two-factor authentication. That basically adds an extra layer of security when you log in. Another thing is cold storage.
Cold storage, like a fridge for Bitcoin.
Uh-huh. Not quite. But basically, it means a chunk of the exchange's crypto holdings are kept offline, which makes them way less vulnerable to hacking and other shenanigans.
So it's like a super secure vault.
Yeah.
Got it. Anything else?
Yeah. Definitely do some digging into the exchange's track record. You want one that has a good reputation in the crypto community? Spend a little time online, see what other users are saying. It's worth it.
Good point. Reputation matters. What about fees? Are they generally higher or lower than like traditional brokerage fees?
It really depends. Some exchanges will hit you with a flat fee for every transaction. Others use this thing called a maker-taker model, which can be a bit more complicated.
A maker-taker model. Okay, now I'm really intrigued. Break that down for me.
So imagine it like a marketplace, right? The makers are the ones adding goods to the market, or in this case, placing orders. And they usually get charged lower fees. The takers are the ones buying those goods, or in crypto terms, filling those existing orders. And their fees are a little bit higher.
Huh. I never realized fee structures could be so complex. Why do they even have that maker-taker thing anyway?
Well, it's all about encouraging liquidity, basically making sure there are enough buyers and sellers to keep things running smoothly. By giving lower fees to those makers, the ones placing limit orders, they're encouraging more trading activity.
So it's like a balancing act.
Exactly. They want to keep the market humming along.
I get it. So besides fees and security, what else should we think about when picking a crypto exchange? I'm also kind of curious about the range of cryptocurrencies available. We talk about Bitcoin a lot, but there's a whole universe of altcoins out there.
Oh, for sure.
Yeah.
Some exchanges focus on just a few cryptocurrencies, while others have, like, a giant selection, sometimes even hundreds of different coins. So if you're thinking about exploring beyond Bitcoin and, the big names, you'll probably want an exchange with more variety.
Variety is the spice of life, right? But what about the whole ease of use thing? Is it generally harder to use a crypto exchange compared to a traditional brokerage platform?
That depends. Some have really user-friendly interfaces, especially the ones that are designed for, people just getting started. Others can be a bit more complex and take a little more time to get comfortable with. It's always a good idea to see if they offer a demo account.
So same as with brokerages.
Exactly. A demo account lets you get the hang of the platform and practice before you're actually risking any real money.
Always a good idea. And I'd imagine, just like with traditional brokerage accounts, it's wise to choose an exchange that's got good educational resources, right?
Oh, absolutely. Look for those exchanges that offer things like articles, videos, tutorials, all that stuff that can really help you understand the whole world of cryptocurrency trading. It can be a lot to take in.
Totally agree. Okay, so we've got the basics down for choosing both a brokerage account and a crypto exchange. Feels like we've built our financial toolkit and we're ready to start investing, right?
Yeah, starting to look that way.
But before we go on a spending spree, let's take a breath and talk about some key principles to keep in mind no matter what you're putting your money into. Our sources had some really great advice. I'm particularly drawn to this idea of diversification. What are your thoughts on that?
Diversification is crucial, especially for, someone who's newer to investing. It's all about not putting all your eggs in one basket, as they say. Instead of betting everything on one single stock or cryptocurrency, you want to spread your investments across different asset classes, industries, maybe even different geographic regions.
So it's about building a more well-rounded portfolio, one that can handle the ups and downs of the market.
Exactly. Think of it like building a house, right? You wouldn't build it on just one single pillar. You want multiple pillars to make sure it's stable and strong.
Makes sense. So diversification helps spread the risk.
Gotcha. What about research? All those sources really seem to emphasize doing your homework before investing in anything.
Oh, absolutely. Research is key. Take the time to really understand what you're putting your money into. Read those white papers, analyze their financials, look at their long-term potential. It's like dating, right? You wouldn't just marry the first person you meet. You want to get to know them, understand their values, make sure you're compatible.
That's a good way to put it. I like that. All right, so diversification and research, check and check. But what about the whole risk-reward thing? Our sources seem to agree that Generally, higher potential returns come with higher risks. So how do you navigate that trade-off, especially as a beginner? That's a big question.
Yeah.
But you hit the nail on the head. Generally, the higher the potential return, the higher the risk. And, the opposite is true too. Those lower risk investments usually offer lower potential returns. It's all about finding that sweet spot that works for you, for your own personal risk tolerance and what you want to achieve with your investments.
Finding that balance. That makes sense.
It can take a little trial and error, but it's worth taking the time to figure out what you're comfortable with. And don't be afraid to ask questions along the way.
Absolutely. There's no shame in asking for help, especially when it comes to something as important as your finances.
So you want to dive into some specific investment strategies? Let's start with one that I think aligns with your love of research, value investing.
Value investing sounds kind of like, I don't know, bargain hunting for stocks. What's the main idea there?
That's actually a great way to put it. Value investors basically believe that the market, sometimes it misprices companies. So they try to find those stocks that are trading for less than what they think the company's really worth.
So it's like finding like a hidden gem at a flea market, right? Something
Yes.
super valuable that everyone else has just completely overlooked.
Exactly. Value investors, they do their homework. They're digging deep into a company's financials, looking at industry trends, really trying to understand the company inside and out. They want those businesses with strong fundamentals that, for whatever reason, the market's just undervaluing at the moment.
It sounds like it requires a lot of patience and maybe even a bit of a contrarian mindset, right? You're basically betting against how the market's currently valuing that company.
Yeah, that's true. Value investing isn't about those quick profits or following the latest trends. It's definitely a long-term strategy. It requires discipline and, like you said, a willingness to go against the grain.
Okay, I can see the appeal for someone who enjoys like digging into the research and has that long-term vision. What about growth investing then? Our sources made it seem a bit more, well, risky.
Right. So growth investing is all about those companies with high growth potential, even if their current valuations seem, maybe a bit high.
So instead of hunting for bargains, you're looking for companies that are like poised to really take off. What kind of companies usually fit that bill?
I think companies in those new and emerging industries, the ones that are like shaking things up, disrupting traditional markets, or companies with innovative products or services, the ones that are pushing boundaries, growth investors are betting on the future. They believe those companies will just keep expanding and bring in those big returns.
Sounds exciting, but definitely a bit more of a roller coaster ride, right? What are your thoughts on balancing that growth potential with managing risk, especially for someone who's just dipping their toes into investing?
It's a balancing act for sure. Growth stocks can be way more volatile than those value stocks we were talking about, so it's even more important to diversify.
Yeah.
Don't put all your eggs in one basket, so to speak. You might also consider, especially starting out, allocating a smaller part of your portfolio to growth investments, just to kind of test the waters.
Makes sense. It's like adding a little spice to your portfolio without like completely overwhelming your taste buds. Speaking of different flavors, what about dividend investing? I remember our sources touched on that as well. Can you break that down for us?
Sure. So dividend investing focuses on those companies that pay out a portion of their profits to shareholders, and those payouts are called dividends.
So it's like getting a regular paycheck from your investments. That's kind of cool. What types of companies typically pay out dividends?
You'll often see them in those more established industries, the ones with stable earnings, like think utilities, consumer staples, or even REITs. A lot of these companies have this long history of paying out consistent dividends, which makes them appealing for those folks looking for passive income or those who are maybe in retirement and looking for a steady stream of cash flow.
Okay, so different strategies for different goals. I'm getting it. Now, what about those index funds and ETFs we keep hearing about? Where do they fit into all of this?
Index funds and ETFs. They're kind of like the all-star team of the investment world. They give you a simple and cost-effective way to diversify your portfolio and get exposure to like a whole bunch of stocks or bonds.
I keep hearing they're a good option for beginners. What makes them so special?
Well, index funds and ETFs track a specific market index, like the S&P 500 or the NASDAQ 100. So instead of trying to pick out individual stocks, you're basically investing in a basket of stocks that represent a particular slice of the market.
It sounds like a more hands-off approach, right? You're not spending hours researching individual companies or trying to like time the market perfectly.
You got it. Index funds and ETFs are often called passive investments because they don't require a lot of effort from the investor. You just pick the index you want to track and boom, the fund does the rest.
Sounds pretty appealing, especially if you don't have tons of time or, deep financial expertise to really manage your investments super closely. What about fees, though? Are the fees for index funds and ETFs typically higher or lower than those actively managed funds?
Generally lower, which is a big plus. See, actively managed funds, they have those portfolio managers who are constantly buying and selling stocks, trying to beat the market.
Yeah.
That expertise, though, it comes with a price tag. And those fees can really eat into your returns over time.
So with index funds and ETFs, you're getting broad market exposure at a lower cost. Not bad.
Exactly. And historically speaking, index funds have actually outperformed a lot of those actively managed funds, especially over the long haul. Not to say all actively managed funds are bad, but it really shows the power of passive investing and, keeping those fees low.
That's a compelling argument for sure.
Mm.
So, how do you decide which investment strategy, or maybe even combination of strategies, is the right fit for you? There are just so many options, it can feel overwhelming.
It really comes down to your individual goals, how much risk you're comfortable taking, and your time horizon. How long do you plan to invest for?
Okay, so let's break that down a little bit. Let's say someone is saving for retirement, which is, decades away. What kind of strategy might make sense for them?
Someone with that long time horizon, they might consider putting a bigger chunk of their portfolio into those growth investments. They have more time to ride out any market ups and downs and potentially, reap those bigger rewards.
Makes sense. They have more time to recover if things go south for a bit. What about someone who's like closer to retirement or maybe looking for more stable income?
For someone in that situation, they might prioritize those dividend-paying stocks or even bonds, which can provide a more consistent flow of income. Maybe even allocate a portion of their portfolio to more conservative investments, like those index funds that track a broad market index, just to add a bit of stability.
So as you get closer to retirement, maybe shift to a more, I don't know, a more cautious approach, right? Protect what you've built up.
Exactly. It's all about adjusting your strategy to match your needs and your circumstances as they change.
This is all super helpful. I feel like we've really demystified the world of investing a bit. We've given our listeners a framework, right? A place to start.
Hopefully so.
But there's one more piece I want to explore before we wrap up. The mental side of investing. Our sources really touched on this, like managing your emotions, avoiding those common pitfalls. What are your thoughts on that?
Oh, that's huge. It's a crucial part of investing that people often overlook. Even the best investment strategy in the world can go off the rails if you're letting your emotions make the decisions.
I've definitely been there. It's so easy to get caught up in the fear and greed of the market. What are some tips for staying level-headed, for not letting those emotions take over?
Well, one of the most important things is having a clear investment plan. And then, this is key, sticking to it, even when the market gets a little bumpy. Don't let those short-term fluctuations mess with your long-term strategy.
So resist that urge to panic sell when everything's going down or, chase those hot stocks when the market's on fire.
Right. It's like sailing a ship through rough waters.
Yeah.
You have to keep your eye on the destination, not get distracted by every single wave. Stay the course.
Love that analogy. What about that fear of missing out, FOMO? It seems like everyone's making a fortune in the market, especially with all the hype around crypto. How do you deal with that?
FOMO is definitely a real thing. But you have to remember, not every investment is right for every person. Don't feel pressured to jump on the bandwagon or, invest in something just because everyone else is doing it. Do your own research, make your own decisions based on what makes sense for you.
So it's about tuning out the noise and really focusing on your own goals and risk tolerance.
Exactly. And if you find yourself getting swept up in the hype, just take a step back. Take a deep breath and remind yourself of what you want to achieve. Does this investment fit into your overall plan? Or are you just chasing a quick buck? Ask yourself those tough questions.
That's great advice. So have a plan, stick to it, and don't be afraid to walk away from something that doesn't feel right. What about that confirmation bias we were talking about earlier? Our sources mentioned that too, right?
Oh yeah, confirmation bias. It's a tricky one. It's that tendency to just look for information that confirms what we already believe, even if it's not the full picture. Like if you're already convinced that a certain stock is a good investment, you might just ignore any negative news or warning signs. You're not seeing the whole picture.
So it's like wearing those rose-colored glasses, only seeing what you want to see.
Exactly. It's super important to be aware of that bias and actively seek out different viewpoints. Don't be afraid to consider all sides of the story before making any decisions.
That's a good reminder. Be open to different perspectives. Be like a detective, right? Gather all the evidence before making a judgment. Any other psychological traps we should be on the lookout for?
There's anchoring bias. That's another common one. It's a tendency to get fixated on a particular piece of information, even if it's not really relevant anymore. Like say you buy a stock at 50 bucks a share and then it drops to 25. You might be really hesitant to sell it because you're stuck on that initial price you paid.
It's like holding onto a sinking ship because you're, I don't know, too attached to the memories you made on board. You can't let go.
Uh-huh. Yeah, kind of. It's important to remember to evaluate those investments based on what they're worth now,
Mhm.
not what you paid for them in the past.
So detach yourself from those emotional anchors and be realistic about the current situation.
Got it. This has been incredibly insightful. We've covered so much ground. I feel like we've given our listeners a ton of tools, not just for understanding the mechanics of investing, but also for like navigating the mental game, which can be just as important.
Absolutely. Investing is about way more than just numbers. It's about understanding yourself, your goals, your risk tolerance. It's a journey.
Okay, so we've talked about all these different investing strategies and even like the mental side of it all. But how does all this fit into someone's, you know, big picture financial life? That's a great point. Investing is just one piece of the puzzle. You got to see it within the context of your broader financial goals. Whether that's buying a house, retiring comfortably, or just like achieving that financial independence you've been dreaming of.
So it's not just about like picking hot stocks or buying Bitcoin. It's about making investing part of a bigger plan.
Exactly. And that plan should include things like budgeting, saving, managing debt, all that good stuff. Think of it like building a house,
Mhm.
right? Investing is the roof, but you need a strong foundation underneath to support it.
Love that analogy. It really highlights how important it is to get those financial basics down before you even start thinking about investing. Speaking of basics, one of our sources mentioned this thing called the 50-30-20 rule for budgeting. Can you walk us through that?
Sure. The 50-30-20 rule is this popular guideline for budgeting that says you should split your after-tax income into three categories: 50% for your needs, 30% for your wants, and 20% for savings and paying down any debt.
Okay, let's break that down a bit. What exactly falls into the needs category?
Needs are basically your essential expenses, the things you absolutely can't live without. Things like housing, food, utilities, transportation, healthcare, the essentials.
The things that keep you going day to day. What about the wants category? Those are the fun things, right?
Wants are definitely the fun stuff. They're the things that, make life enjoyable, but you don't necessarily need them to survive. Dining out, entertainment, travel, hobbies, that new gadget you've had your eye on, things like that.
Needs are the must-haves, wants are the nice-to-haves. Got it. And then the last 20% goes towards savings and paying off debt. Any tips for managing those two things effectively?
Well, when it comes to saving, it's smart to have both short-term and long-term goals.
Mhm.
Short-term savings might be for, I don't know, an emergency fund, a down payment on a house, or maybe a vacation. Long-term savings is usually focused on retirement.
Like having different buckets for different things.
Exactly. And then for debt, there's a bunch of different ways to tackle it, but one popular method is the debt snowball.
Debt snowball. Okay, tell me more.
So with the debt snowball, you basically focus on paying off your smallest debt first, while making minimum payments on everything else. Then once that smallest debt is gone, you roll that payment amount into the next smallest debt, and so on. It creates this like snowball effect.
You're gaining momentum as you go.
Right. It can be really motivating to see those debts disappear one by one.
Makes sense. Our sources also really emphasize the importance of planning for the future, especially retirement. What are some key things to keep in mind when it comes to retirement planning?
It's never too early to start thinking about retirement. If your employer offers a 401k or a 403b plan, definitely take advantage of it, especially if they match your contributions. That's basically free money.
Don't leave money on the table.
Right. And even if you're self-employed or your employer doesn't offer a retirement plan, there are other options like IRAs. Traditional IRAs, Roth IRAs. They offer tax advantages and can really help you grow your savings over time.
So many options. It's amazing.
It is. There are a lot of tools out there to help you plan for a comfortable retirement.
Awesome. Okay, so we've got budgeting, saving, managing debt, planning for retirement. Feels like we've really covered all the bases for building that strong financial foundation.
Yeah, we've laid a good groundwork. And remember, financial planning isn't something you do once and forget about it.
Yeah.
It's an ongoing process. You need to check in regularly, make adjustments, make sure everything is still aligned with your goals.
That's like tending a garden, right? Water it, weed it, make sure everything's growing how it should.
Exactly. And just like a garden can bring you joy and, nourishment, A well-tended financial plan can bring you peace of mind and that financial freedom you're looking for.
Couldn't have said it better myself. Wow, we've covered so much today, from the nitty-gritty details of choosing the right investment platforms to the big picture stuff like financial planning. I feel like we've given our listeners a pretty comprehensive toolkit for navigating this whole world of investing and personal finance.
We've planted a lot of seeds today, and hopefully they sprout into, a flourishing garden of financial knowledge and empowerment for everyone listening. This is your journey, your adventure to unfold.
Take your time, ask those questions, and never stop learning. There's always more to discover.
And most importantly, don't be afraid to take those first steps. No matter where you are in your financial journey, there's always room to grow.
That's what the deep dive is all about. Thanks for joining us on this incredible financial adventure. And remember, until next time, keep diving deep.